Welcome, everyone. Another Financial 15, the show where we try to provide some financial knowledge, something you can hopefully use and improve your situation. Today, we're looking at the difference between a registered account and a non-registered account. What's the difference? We're going to get through all of that today. You want to stick around.
Yeah, today we're touching on something that we've talked about forever, but really never clearly defined. What is an RSP? Is it a registered account? What's a cash account? What's a margin account? I think it's important that we get the clarifications as to what they are so that you know exactly what you're investing in. If you want, please go and find more of our videos on this or anything else we've done at our YouTube channel. Please subscribe. Lots of great content you can find there, or like us on Facebook. And most importantly, always visit us when you get to our website at beckerorr.com. There is great content there, and you can only get so much more from everywhere else. So today we want to talk about registered accounts, non-registered accounts. Clint, this is a big definition difference. There's a lot of things going on there, isn't there? What do you want to start off with?
Yeah, let's start off right at the start. That's a good place to start. The registered accounts. Now, the registered accounts, generally all of your acronym soup, at least the bulk of your acronym soup in the financial world, has to do with registered accounts. That's going to be your RSPs, your RIFs, your LIRAs, your LIFs, your PRIFs. All of that is part of the acronym soup that is the registered account. Quick note, not always, but most of the time, you know it's a registered account if somewhere in that acronym there's an R. If there's an R in the mix of it, probably a registered account. That's pretty safe bet.
That's
But those
true.
are the examples of registered accounts. We'll quickly look at two kind of big categories for registered accounts. You have your contributing accounts. Those are ones you put money into. That would be an RSP, for example. That moves over to a RIF, a PRIF, maybe an RDSP. That could also be an example of a contributing account. And then you have those locked in ones, Kevin, right? Those are the ones that could be part of a work pension program, some kind of pension plan. They will fall into a LIRA, a LIF, that type of idea. So two big categories that fall under that registered account umbrella. But what do all registered accounts have in common? There's a couple of themes here, Kevin, right?
Yes, there is, definitely. And what they all seem to have in common is that they're dealing with this basis. The money that you're earning in there is tax sheltered. So while you are sitting there and there is compounding going on, you're not paying tax on this. So as long as it's left in this registered plan, the money can grow and grow and grow, and we don't have to worry as much about, are we going to be paying this scenario out? So, and having to pay tax on it on a yearly basis. No, we're allowed to compound that as long as it's in that plan before we start doing any sort of the withdrawals out of there. That's one of the options that we have. What else do we have to deal with when we're dealing with registered accounts in general?
Yeah, so two big themes. You tackled the first one there. It's that tax deferred growth. So what happens when you put it into the account? Well, that'll depend on the type of an account. An RSP, for example, of a different than an RDSP or another kind of registered account. But ideally, it'll be something at the upfront. You'll get that tax deferred growth. Then unfortunately, you could have some tax when you take the money out. But that's a separate video dealing how that works for every account. The theme, though, registered accounts, you said it. You get the tax deferred growth. The second theme, the ability to name a beneficiary. So you can have your RSP, your LIF, your PRIF, whatever acronym, you can name a beneficiary on that. So that bypasses the will. Important to keep in mind. So part of your estate plan, you need to know those registered accounts will go directly to the beneficiary you name and will not go through your will because they will not be part of the estate. So you incorporate that with your estate plan, but those are the two key themes for a registered account: the tax deferred growth and the ability to name a beneficiary. A couple of exceptions in this category, aren't there, though, Kevin? There's always a few.
Yes, there is.
I'll pull up the first one here. The first one is the education account, which technically is a registered account, just a little different, right? It's not like your RSP.
No, it isn't. I mean, in a lot of registered accounts, when you're putting money in, you can get a tax deduction up front. Not every one, but a lot of them you can. The RESP is after-tax money you're putting in. It is same scenario where you're tax sheltered, but you're also getting money put in from the government. The government is giving you a contribution depending on how much you're contributing in there. The other factor is that when money comes out of a registered product, a lot of times what goes on is the income that is charged to the name of the party on that RSP, that RIF, whatever the case may be. In the case of the RESP, the money is taxed in the hands of the beneficiary, the person who the plan was put together for. So if it's coming out, they are the ones that are going to have to pay tax on whatever goes in that has been earning an accumulation or government cash along those lines. So it's a slightly different setup for some of those odds and ends with the RESP going forward.
Yeah, and we do have other videos that'll go more deeply into an RESP, but just to aware, it's part of the registered category. If someone says registered account, this is in there, but a little different. Another exception TFSA, right off the hop, there's no R in there, so it just seems
No.
weird. But it is technically a registered account. The tax-free savings account has the same theme where the money within the TFSA will grow tax-free, similar to an RSP and RESP, part of that same theme. Also, you can name a beneficiary. We talked about
That's
the two
it.
themes, registered accounts. It hits both those categories, but the money you put in, no tax deduction up front. The other side, the money you take out, you're not paying any tax on that end. So a different type of registered account, but still a registered account nonetheless. So as a quick overview of registered accounts, some of the common themes. Let's move on at the next category here, the non-registered accounts. Kevin, give us a quick walkthrough of the non-registered accounts.
Yeah, basically, when we talk about a registered account and the difference between that and a non-registered, as Clint mentioned, as we've said before, themes that the money that's been put in is tax sheltered. You're not paying tax on it every year. It's allowed to compound that way. Plus, you have the beneficiary. Non-registered accounts do not have that option. This is all after-tax money. So whatever you're investing in, if it's earning something, whether it's a capital gain, a dividend, an income, you are going to pay tax on that on a yearly basis because of what you've earned. And option number 2 is no non-registered account has any beneficiary to it at all. You cannot will a non-registered account to somebody else. There are ways to try and help with that. That could be planning for your estate. And we've talked about that in other videos, and we'll get to that lately. But yeah, this is all after-tax money. This is all non-registered. It is not protected, and you will pay taxes on it on a yearly basis, depending on how you earn.
Yeah, so you think about it. Registered accounts, I don't pay tax every year. It's just kind of deferred. There might be something on the withdrawal. The non-registered pay-as-you-go system. Every year, you're going to have to claim something depending on what happened in the account. Registered account, you can name a beneficiary. Non-registered, you can't. So those two big themes, they're opposing, essentially.
Yes.
And that's the big difference between registered and non-registered. Some names, just if you hear cash account, you hear margin account, or maybe as a joint account, those are all non-registered accounts, just different names. And they are done for separate reasons. A cash account doesn't mean the money's just in cash. You can invest it. It can be in stocks. It can be in bonds. It simply distinguishes cash from margin. And margin, leave it to the financial world to come up with fancy names and terms here. It's essentially the ability to borrow money. You put it in the account. The brokerage firm will lend you money so you can invest even more into the market and they'll lend against the assets within the account. Cash accounts don't have that ability. So it's really cash versus margin. That's the difference, whether or not you qualify for that leverage, that lending. And then a joint account, as you might imagine, has more than one person on there. It simply indicates you have multiple parties that are part of that account. And you can do different currencies, right? You can have a Canadian one, a US one, maybe you have one for a European currency, but different currencies. And those are the 3 big categories for your non-registered accounts: the cash, the margin, and the joint account. Did you want to add anything to that, Kevin?
Yeah, no, the only thing I would mention is 9 times out of 10, as you say, when you see if you've got a joint account, chances are it will be a non-registered account. The only exception, because if you deal with registered accounts, almost everyone is an individual names. Only the RESP basically can be in a joint name. Everything else, though, if you see joint, 90% of the time, that is a non-registered account. So you will know about it by that way.
That's a very good point. Yeah, we forgot to mention that when we said the exceptions. One of the exceptions, we said TFSA, RESP. RESP is the only registered account you could actually have in 2 people's names. You could have 2 parents jointly holding an RESP for their kids, as an example. But you can't have 2 people's names on a TFSA or on an RSP. So that's really the only one you could have a joint. Every other case, a joint account is going to be a non-registered account. So that's a very good point. Well, we'll go through a quick example here. We're looking at the taxation side. So remember, a big theme: registered accounts, you don't pay any tax as you go. Only when you take the money out, usually. In non-registered accounts, you do pay as you go. So this is applicable to non-registered accounts. We're looking at the different types of tax, different types of way you can earn income within a non-registered account and how it could be taxed. Lots going on here, Kevin. Why don't you help make sense of it?
Yeah, exactly. I mean, as I mentioned beforehand, one of the things that you do get on all investments is if you're earning something, you're either earning interest income, you're earning dividend income, capital gains, or return of capital. And again, depending on how that is, it's all taxed differently. Interest income, as it says, basically from a fixed income investment, mortgages, GICs, bonds. This outside and a non-registered investment account is treated as fully taxable. So in our example here, if you were earning 90 grand in income and you had 1,000 that you'd earned in interest, $379 or 37.9% of that is being taxed. If you deal with a dividend, you are allowed what's known as the dividend tax credit. So they gross it up and then they take a credit off for it. So in this case, it'd only be $205.30. When we deal with the capital gains, of course, capital gains exclusion on this would be you've sold a stock, you've made money off it. You're only showing the government half of that gain though. So half the tax is free, half is included in your income. That's why we get the 189. And of course, return of capital basically says that they're paying out money for you. What that's doing is it's lowering your cost base. But again, a return of capital investment has absolutely no tax on it. So those are basically the four types of tax or the four types of income that you can generate off of an investment scenario that's non-registered, and that's the tax consequences. But this doesn't apply to everything. It's just really in the non-registered side, isn't it, Clint?
Yeah, this is specifically non-registered because that's the pay-as-you-go system. Every year you have to pay on the non-registered account. You see the last column there, that's just an example, and it uses Manitoba as a reference point, 2022, and someone that had 90,000 of income, and then they earned an extra 1,000 of interest income or an extra 1,000 of dividends or capital gain. You can see the various taxation. Interest income tax the most, dividends the second most, capital gains third on that list, and then return of capital the most tax efficient. So you have just a quick example of how that works out. And regardless of where you are in Canada, if you're in Ontario or Quebec, like the numbers might be a little different, but the ranking would be the same, where interest income tax the most, return of capital tax the least. Quickly here, we're going to bring it all together. We talked registered, we talked non-registered, we talked about the different ways you can earn income. It really applies to non-registered accounts. So what does it mean per account? Your registered accounts, your RSPs, your RIFs, your LIRAs, your LIFs, you really don't pay any tax as you go. You only pay tax when you take the money out. So all those prior forms, interest, dividend, capital gains, doesn't really matter inside of an RSP or inside of a LIRA because you don't pay the tax until you take it out. And when you take it out, all of it's income. TFSA, we highlight that one separately because TFSA gets a special category because you don't pay any tax as you go, but you also don't pay any tax when you take it out. So that one is very efficient. And then, of course, any non-registered account, whether it's a cash, a margin, or a joint, everything Kevin just mentioned, all four of those types of taxable income might apply depending on how you set up the investments. And this leads to a bit of a question. If you have these different accounts, Kevin, and they have different tax items that relate to them, what investment should go into which account? There's a bit of a strategy there, right?
Yeah, theoretically, what you would like to do is the income that you're earning off these investments, the ones that are the most tax friendly, you would love to keep outside of your registered accounts, your RSPs, your RIFs, anything along those lines, because they are taxed the best. So fixed income investments, possibly dividend investments, those inside of a registered account probably do very well because they would be taxed higher outside. So having them in there, it's going to give you that benefit by not having to pay it. Capital gains, return of capital outside of an RSP or any sort of registered product, those are the best ones to have there because they have the best tax rate going forward. So you get to keep more money that way. Now, again, that's just a strategy you can use. There's no saying that you can't put equities and capital gains and return of capital in your registered products or that you cannot have interest or dividends outside. You just want to make a combination that works best for you and fits within your risk profile. But those are some of the rationale for areas that you may want to keep certain things based on tax considerations.
Yeah, this is the topic of asset location. Like, where do you hold the asset for tax efficiency? We need to just quickly mention where it ranks is probably lower on the priority scale. You want to make sure you have a plan. You want to make sure that your risk tolerances are met, and then you have investments that are meet your risk tolerance and meet your financial goals. Then you make it tax efficient, right? It's lower on the list. Otherwise, you could have something that's very tax efficient, but maybe it's way too risky for your comfort zone. You don't want to get those out of order. But that was a quick, well, maybe not so quick. We actually went through quite a bit of detail there. But it covers registered accounts, non-registered accounts, some of the key themes, some of the differences, how the taxation may apply. If you have more questions, let us know. You can always go to the website, chatwithclintonandkevin.com, fill in the form. We'd absolutely love to hear from you. Kevin, any parting comments for the folks?
I think we've considered everything pretty well. Just remember the one thing. If it starts with an R, it's probably registered.
That's the key takeaway for today. Take care, everybody.